Just recently, we sold one of our REIT holdings and we then reinvested the proceeds in one of our new top picks at High Yield Landlord. In today's video, I'm going to discuss all of that, but before I get into it, I want to let you know that we are still offering a limited time 2-week free trial for our REIT newsletter, High Yield Landlord. So if you want to access my full portfolio and all my trade alerts in real time, check out the first link in the description of this video. We will soon remove this free trial, so now is your last chance to take advantage of this offer. So the REIT that we sold is called Global Medical REIT. Its ticker symbol is GMRE. It's a REIT in which we invested in 2022. We held it for 2 years in our core portfolio at High Yield Landlord, and we earned a 56% total return on our investment. We did not sell it because we are turning bearish on the company. On the contrary, I expect the REIT to do relatively well over time, especially as interest rates are now cut in the near term. However, we still decided to sell it because we identified a new investment opportunity that's, in our opinion, superior from every perspective. And the REIT that I'm talking about here is called Sila Realty Trust, ticker symbol SILA. It's a new listing. The company just recently came public on the New York Stock Exchange, and it's, in our opinion, superior to Global Medical REIT from every perspective, and yet it's currently offered at a lower valuation, likely simply because it's gone unnoticed by most REIT investors so far. So how do these two REITs differ from one another? Firstly, we should point out that both REITs are quite similar. These are net lease REITs that focus on single-tenant healthcare properties, and they've both done a good job at staying away from the riskiest healthcare properties, which are hospitals and skilled nursing facilities, in which REITs like Medical Properties Trust and Omega Healthcare investors are investing. They've done a good job at avoiding those property segments, and instead they've been investing mostly in medical office buildings and inpatient rehab facilities. Both also have quite a few similarities in their portfolio characteristics. They both enjoy 2.2% annual rent escalations. These are mostly triple net leases, meaning that the tenant is responsible for all property expenses, including even property taxes, insurance, the property upkeep, and so on. Both also enjoy a rent coverage ratio in the high 4s, meaning that even if its tenant's profitability suffered quite a bit, and let's say it was cut in half, the tenant should still be able to pay the rent on time and full to its landlord. But there are two things that we prefer about Sila's portfolio. The first one is average remaining lease term, which is quite a bit longer at 8.2 years versus just 5.5 years for Global Medical REIT. And in this property segment, typically it's a better thing to have longer lease terms, and this is typically rewarded in the private market by the property trading at a lower cap rate, which means that it has a higher property value. And this is simply because these are single tenant properties, and so if you face a vacancy, that could lead to significant losses, and the longer leases you have, the less likely you are to suffer a vacancy. And so we prefer that aspect about Sila. The second aspect that we prefer is that it typically has higher credit tenants than a Global Medical REIT, which is famous for having historically focused mostly on higher cap rate properties in secondary markets and having non-rated tenants. Sila also has the same focus as Global Medical REIT, but we feel like it has typically put a slightly higher emphasis on quality than a Global Medical REIT, and this has come at the cost of slightly lower cap rates, but still we prefer the approach of Sila from that perspective. And if we look at their tenants, it's evident that they have a higher credit on average. Sila generates a pretty significant portion of its rental income from investment grade rated tenants or from tenants that are giving corporate guarantees to the landlord. If we look then at the tenants of Global Medical REIT, it has some names like Steward in there, which makes up about 5% of its FFO. Steward is the biggest tenant of Medical Properties Trust, and it's going through a bankruptcy at the moment. You may be aware of this, and so we think that Global Medical REIT is going to have to release this specific property, and it has other similar situations in its portfolio, which are likely to lead to some challenges down the line. But while we slightly prefer the portfolio of Sila versus Global Medical REIT, the difference is really not that big. The real difference is in the balance sheet quality of both REITs and their future growth prospects. Here there is really a big difference because Sila has a very strong balance sheet. It's arguably under-leveraged. Its LTV is only about 20%. Its debt to EBITDA is just 3 times. This is one of the lowest leverage ratios in the entire REIT sector, let alone the healthcare peer group. I'll put a chart on the screen that makes this evident. And in comparison to that, Global Medical REIT has about 2 times more leverage. So its debt to EBITDA is about 6 times. Its LTV is about 45%. And that's quite a bit REIT in today's higher interest rate environment. And yes, interest rates are likely to come down in the near term. That's great for global medical REIT, but still, they're likely not going to come back down to where they were at the lowest point of the pandemic. And so this is likely going to remain a headwind in the coming years, especially knowing that global medical REIT also has shorter debt maturities than Sila. Sila has not a single debt maturity since till 2028, whereas global medical REIT is going to have some in nearly every year going forward. And another big difference that's important to mention here is that Sila is retaining significant cash flow to reinvest in growth and even deleverage if it wanted to. It's retaining about 30% of its cash flow, so its dividend is really well covered and it's able to keep growing organically with this retained cash flow. In comparison, global medical REIT is not retaining anything. It's barely covering its dividend at the moment, and this is a problem given that global medical REIT should really focus on deleveraging, and so we think that there's a pretty high risk of a dividend cut down the line, especially if it faces further rent collection issues, such as is with the case of Steward. So with that in mind, you can now imagine that there's going to be a pretty significant disparity in their future growth prospects, because global medical REIT is not retaining any cash flow. It has significant leverage, relatively short debt maturities. Its interest expense is going to go up. It's not going to be able to acquire a lot of new assets. Now compare that to Sila. It's retaining significant cash flow, it has zero debt maturities for years to come, and it's under leverage, meaning that now if it wanted to, it could just significantly expand its leverage, buy more properties, and it will be buying these properties at a pretty large spread over its cost of capital. Again, remember, it has a very low leverage, so I think that lenders will be very happy to work with Sila. And now interest rates are going to go down in the near term, assuming that it's able to borrow at 5.5%, and it's buying properties at an 8% cap rate. That's a 250-300 basis point spread over its cost of capital, and that's very significant. Remember that typically net lease rates like a Realty Income, Agri Realty, and so on are happy if they're able to earn 150 basis point spread, and so Sila could do about double of that simply because it's under leveraged. But now it has made it clear on their recent conference call that they plan to increase that leverage going forward, buy more properties, and this is going to significantly expand their FFO per share. You add to that the 30% retained cash flow, you add to that also the 2.2% annual rent escalations from its existing portfolio, and you have a very attractive growth story. I think that the REIT could be growing its FFO per share at a high single-digit growth rate now for quite a few years going forward. That's very attractive, coming from a REIT that's still quite cheap. When we invested in the company, it was trading at $22.60. That was valuing the company at about 10 times FFO, which was a lower multiple than what global medical REIT was trading at when we did this transaction. I'll put a chart on the screen that will show those valuations. Today, Sila is already a bit higher. In just about 1 week, it surged by about 10% as we put out this research and people acted on it. But even today, you're not really paying a premium for Sila, despite it having, in our opinion, a slightly better portfolio, a much stronger balance sheet, and much better growth prospects. And so, in our opinion, it was really a no-brainer here to sell global medical REIT, to reinvest those proceeds into Sila Realty Trust. And even today, despite its now slightly higher share price, we think that this remains true. But this also shows you the value of getting access to our trade alerts in real time. Until recently, almost no analyst had put out research on Sila. This is why it was trading at such a steep discount. Now the research is slowly coming out, and the REIT has already started to reprice higher. And we don't think it's too late, but it always helps if you're getting that research in real time. Once again, as I mentioned earlier, we're still offering a 2-week free trial. So if you want to access our full portfolio and all our research in real time, there's a link to it in the description of this video. But what else can I say about this REIT? It's offering a near 7% dividend yield. This is paid on a monthly basis. It's very well covered. It is true that global medical REIT is offering an even higher dividend yield, but remember that this is simply because of its payout ratio being at around 100%. We much rather own a safe and growing 7% dividend yield than a risky and flat 9% dividend yield, which is the case of global medical REIT. And ultimately, we think that the fair value of this REIT is at 13-14 times FFO, so there is another 20-ish, 30% upside potential from multiple expansion. This could be realized now as the growth rate of the the REIT accelerates as it expands its leverage, and this is going to improve its market sentiment. More and more investors are going to want to buy the stock of Sila. Also, simply as they're gonna now start attending major REIT conferences, more people will become familiar with it, more analysts like us will put out research on the opportunity. Interest rates also going to lower levels. So there's a lot of catalysts, I think, for its multiple to expand a bit. The growth story is very attractive. We like their properties. To finish this video, perhaps what are the risks? The main risks are that this remains a relatively small REIT, and what it means is that it has relatively high exposure to its top tenants. I think its biggest tenants from the top of my head makes up about 15% of its rental income, and this is a private company, so we don't have access to their financials. But again, keep in mind that the average rent coverage ratio of this REIT is nearly 5 times, so there's pretty good margin of safety. Its properties are very profitable at the property level, and based on the information that we have, these tenants, top tenants of the REIT are doing relatively well. But it's something to monitor and keep an eye on, and that is also why you're not gonna invest all your REIT capital into this single REIT, and why you would rather include it as one REIT in a well-diversified portfolio. And that's exactly what we're doing at High Yield Landlord. It's just one position among 24 others in our core portfolio. Once again, if you want to access our full portfolio, you can join us for a 2-week free trial. You won't be charged anything in the first 14 days. Thanks so much for your interest. Please click the like button, subscribe to the channel to not miss our future videos on other REIT investment opportunities, and otherwise, see you at my next one. Bye-bye.